Beautiful humans, happy Tuesday. Today I have the pleasure to be here with Arjun Kumar and Eamon Shahir. Both are founders of a beautiful software platform that I've used recently to actually submit my own self-employment tax return called Text. And yeah, both of them have been previously working with PwC on making companies more tax efficient. And now really the mission for the two of them and their company is to bring the knowledge that big companies use to retain more of their income within the business to making it available to everyone through the help of technology. So what we'll do today is, Arjun and Eamon have prepared a beautiful presentation that will take us through talking about like what can we actually do as sole traders and creatives, coaches, influencers to make our companies more efficient from a perspective of tax. And so if there's any questions along the way, please post them either in the question box here at the bottom, or you can put them in the chat, and then we'll get to them as we go. So with that, if the two of you want to say a few more words about your company, and then we get into the presentation. Thanks for being here, folks.
Much appreciated, and thanks for the warm introduction, and nice to meet you all as well. What we'll do is we'll share screen so you can see this sort of presentation. We'll give a bit of an introduction to ourselves and tax, and then we'll jump into some tax efficient content. So how do you set up your business in the most tax efficient way, what you can and can't expense, what's the different requirements as a sole trader, and when might be a good time to switch over to start a limited company as well. Does that sound good?
Yes. That's amazing, man. Super exciting.
So, right, let's kick it off. So I guess, tax for coaches, influencers, and creatives. And I guess just a bit about us. Myself and Eamon, we both worked at PwC. I joined around 7 years ago in 2015. And as you can see, we spent a lot of time at our kind of Christmas parties, myself and Eamon in our Santa hats. And that's where I guess we trained up as tax accountants. But we also worked in our technology team, and that's kind of where that emerge or that love for, I guess, tax and technology came together, from my perspective anyway. But I'll let Eamon introduce himself too.
Yeah, happy to be here, guys, and thanks for the intro, Tobias. So yeah, as I've said, I'm actually joined PwC in 2018 as after completing a software engineering degree. So I actually made a bit of a switch and went from tech into finance and tax. Done my 3 years accounting exams, specialised in tax for personal situations, sole traders, and people with sort of international affairs. And then, as Arj said, we sort of met in the technology team where we started building automation for our clients. And then we both sat down and decided, well, hang on a minute, we can take this automation to everyone: personal taxes, sole traders, small businesses, and I guess that's how tax was born.
Yeah, awesome. Thanks, Eamon. So I guess kind of where we are today is we've built Tax, launched it a couple months ago, and Tax really helps to maximize your tax efficiency. So when it comes to filing a self-assessment tax return, the usual historic way of doing it might be to use an accountant, pay high fees, and have to fill out a long spreadsheet, or you file yourself, but you may not be maximizing your tax efficiency. And what we're aiming to do is help people keep more money in their pocket. And we'll talk a bit more about that later on. But that's, I guess, not our end goal. The end goal for us at Tax is really to make tax a completely autonomous thing where we support sole traders and limited companies and just kind of businesses in general become more tax efficient, keep more money in their pockets, all while the compliance element is completely automated. So there's less time being spent on admin, on the stressful receipt collection and all of that stuff. So that's where we're heading. But I guess before we get into the actual content, we wanted to do a bit of a quiz, a bit of a survey, a bit of a poll. So if you have your phone with you, you can scan the QR code on screen, or you can go to slido.com and type in 086716. And this will sort of give us a bit of an idea as to what everyone's thinking, what everyone's doing, and it helps us sort of frame the content to come as well. So you can scan the code on screen, or you can go to slido.com and type in the code 086716. just give everyone another 15 seconds or so to join, and we'll kick off. Sometimes with tax content, it's good to have some surveys in there, adds that different flavor to just numbers and calculations. Cool. We'll get going with the first question. So what do you think when you hear the word tax? Any thoughts? So you can type it in on your phone, on your screen. We got stress. That's certainly something that we hear. A lot of tax can be super stressful for those who they have to file a tax return or even have to manage their earnings, expenses, and so on. Complicated. Money invested where I'm not in charge, 100%. It feels like sometimes we're just kind of giving money to the government to host their own parties when we could be hosting parties of our own. Roads, bridges, and armies. I like that one. Nice. So overall, I'm kind of sensing a bit of a negative sentiment here. But the aim really, hopefully after this next 50 minutes or so, is that we're in a position where we can take control of our taxes a bit more, become more tax efficient, keep more money in our pocket, and really use tax as an instrument to increased freedom. So I guess at the moment as well, do you currently use anything to track your earnings and expenses? A lot of us might keep it on our minds, or might use spreadsheets and so on, or just look at bank statements. We've got a question in, can I rewatch this later? And the answer is yes, you can rewatch it later on too. Thanks, Tobias. So it looks like spreadsheet seems to be the most kind of popular one, but also using online software and apps, and also bank statements. I'm glad that no one selected nothing or just your brain, because that can sometimes be quite hard to memorize after a whole year of spending. It's good to keep this up to date, and we'll talk about the different types of expenses, different capital allowances, and different things that you'll need to sort of keep in mind when it comes to filing your tax return. But nice, keeping that up to date on a spreadsheet is good. How do you currently file your tax return? This one helps us out a bit to understand what current ways you might be filing. Is that filing yourself, using an accountant, using software, or other? So we've got nothing updated on screen yet. Oh, we've got accountant, 75%, myself, 20%, software. So a bit of a mix here. But this is good to see. So we can, I guess, start to paint a picture of the different ways that we can file. And accountant, yourself, or software seems to be the common themes. So we'll move on. We'll go on to, I guess, sole trader requirements and best practice. And for this, I'll pass over to yourself, Eamon, to talk us through requirements and best practice.
Perfect. Thanks, Arj. It's always nice to see the answer to those questions. I don't think I've ever seen a positive response in my entire career in tax with every conversation I've ever had. But usually by the end of it, things are a little bit better. And I think the idea here is just before we jump into going through expenses and looking at efficient ways of paying yourselves and going through companies, I thought it was just important to sort of go through, I guess, the UK legislation on a very high level in terms of what are the actual requirements of an individual, whether if they're acting as a sort of a sole trader and working outside of, say, a standard employment PAYE contract, right? So I guess the first point is, if anyone in the UK earns £1,000 or more in revenue, completing any form of, could be consulting, product designing, or it could be as simple as some personal training, any sort of side income over 1,000 is meant to be reported on a self-assessment. So that doesn't take into account expenses. So you could, of course, generate a loss, but it's about having £1,000 coming in to your accounts. And the requirements are, so we look at the sort of standard UK tax year, so 6th of April to the 5th of April. So it's income earned within that tax year. And the self-assessment, the tax return, is always due the January following the tax year. So the current requirement for people is for the tax year that's just ended on the 5th of April this month. And you all have until the end of January 2023 to file your self-assessment. So once you've sort of established, right, that you have, this self-employed income and you need to file your return, the next step is, well, you've got two methods that you can essentially file your tax return on. It's known as the cash basis and the accrual basis. It's the two forms of accounting you can pick. Now, traditionally, most people who are in sort of that small business sort of element, so that's a profit of under 50,000, use the cash basis. It's the most simple method of reporting, and all you essentially do is you report your income and expenses as they come in and out of your bank account, so real-time transactions. The accrual basis, also known as sort of the accounting method, is if you, for example, have debtors, or you are sort of invoicing your work and you're yet to receive payment. So you will actually record the transaction when you make the invoice rather than when you receive the actual cash in. Now, you're probably thinking, why would anyone, do the accrual basis? And it isn't very common, but some reasons people do it is because they want to claim sort of interest on finances. So it's usually larger companies, because there's a £500 cap for you guys on any sort of finance charges you incur. So accrual basis takes off that cap. It's for companies that might have a lot of stock. So, they have a valuation based on stock. And then an interesting point is this sort of loss relief. Now, my understanding is you guys are all sort of sole traders and contractors, so you don't have employment positions. But if you were, there is a way you can use some of your loss in a self-employment to offset against the income of your job. So once you've established sort of the basis, as I said, for most people, it's cash basis, in and out, you need to keep some records right throughout the year. Now, for you guys, bank statements is usually absolutely fine. So I don't know how you guys track it right now, but the common best practice is you have a sort of separate bank account for your business, right, for your sort of sole trader, and you have all your revenue and expenses going out of that one account. And then if there is ever an investigation known as SA 109, you can simply give these bank statements to HMRC, and that will be absolutely fine. Obviously, if you've made some payments in cash, then you'd need some receipts. So I guess as well, a point to make is self-assessments are in the name, they're self-assessed. So you essentially are self-reporting. You get to make up what goes on there, and the chances are it's not going to be questioned. There are, of course, some things that will trigger HMRC to come and have a few questions with you, and that's usually drastic changes in income or expenses year on year. It could be that you're in a particular field which they see as more risky, like, for example, crypto trading. And again, it could be a variety of reasons that they think the expense number is too high for what you do. But genuinely, we see sort of SA 109 investigations very, very small. But just it's good to have those records if that happens. Perfect. So yeah, and then last few points, capital allowances. I know Arj mentioned it at the start. So capital allowances is essentially any long-lasting items you buy for your business. So that could be, high-value camera equipment. It could be, laptops, iMacs, etc. Or it could be a vehicle. Now, on the cash basis, which is again what most people use, All your sort of long-lasting items you can fully expense, and you'll get full relief for that. The only exception is vehicles. So if you guys, are buying a vehicle which you use maybe to go to client sites, or you use it for your business, you can claim relief on this vehicle, but it will be under the standard rules. And the standard rules at the moment uses CO2 emissions, and you get sort of an 18 or 6% relief unless it's electric. Now, the key point to mention here on vehicles is you can only apportion the cost based on the percent you use the car or van for your business. So obviously taxi drivers are probably going to say 100%, and you guys may hit 10 to 20%. I'm not sure on how much you'd use the vehicle, but it sort of can be claimed and expensed. Another point I get a lot of questions on from sole traders and small businesses is VAT. So just a quick point on that. The VAT threshold is 85,000 in the UK. Now, a common misconception is people think once I hit £85,000 of revenue, that's when I need to register for VAT, but it's actually forward looking. So for example, if you were to make 7,000 a month, and you know that's going to be consistently coming in, you would have to register at the point the VAT threshold is going to take place. And for some of you guys who aren't near the VAT threshold yet, if you are to ever have to claim VAT, any expenses you made in the past, which you paid VAT on, you could expense. So you would get relief up to 6 months for any software expenses and 4 years for sort of hardware expenses. And then the last 2 points, payments on account. So for you guys who do your self-assessment, I guess you know that obviously as you're not paying tax each month from PAYE, HMRC are trying to make it a little bit more fair. So what they ask is if you have got a tax liability, that you make an upfront payment for next year. So that's normally 50% in the January where you file your return, and 50% in the following July. And then apart from that, I just was a random point is when you have the sort of running your guys' self-employment businesses, is just to keep into considerations when you're running your expenses and your reports, the net profit you're reporting is used for things like obtaining a mortgage. So you should always, as well as looking at saving tax and certain incomes you're reporting, always picture it into your overall life, right, in terms of what you need to be reporting as a profit or loss. So yeah, I'll hand over to you, Arj, now to get through some sort of exciting expenses. That's the sort of legislation side covered. Cheers, guys.
Yeah, can I just ask you real quick, Eamon?
Yes, sure.
When you speak about like keeping records, so in my case personally, I use Xero to basically do my receipts and things.
Yeah.
Is it okay if I just basically keep these receipts digitally, or do I need to keep them actually in paper?
No, digitally is fine. Okay, cool. Yeah, normally what will happen is HMRC will send you a letter if they do investigate and ask for any checks. And then what you can do is you'd either probably have to sort of get them printed because HMRC are quite old school. But as long as you have the records digitally and able to obtain them if asked, that's fine.
Awesome. Thanks, man.
No worries.
Cool. Thanks, both. So I guess we'll move on to expenses. We're going to focus a bit on expenses in the next couple of minutes, but there are a variety of ways that you can reduce your profit or reduce your income to get to your figure for what would be taxable with HMRC. And there's a couple other ways as well that you can reduce your tax amount through different allowances, different types of reliefs can all support to reduce that end tax amount that you pay. But we'll start with expenses. And I guess in theory, anything that you use wholly and exclusively for your business can be expensed. For example, if you have to buy a camera or buy some software for your work and it's used only for work, that can certainly be expensed. For things that might have some personal use, and this is quite sort of common from the sole trader perspective, when our lives are kind of mixed between our sort of business and our self-employment, sorry, our life and our self-employment, we can apportion out costs, and that's things like mobile phones, car costs, and things like that, where we can claim part, let's say 45%, 90%, based on how much we use something for work. And overall, many expenses, it depends on your industry and your type of work. And we'll talk about a few examples in a couple seconds that we think might be relevant to you. A couple examples that we have seen as well is from our current users at Taxed, is not knowing that they can claim their car costs or working from home costs. And even though you can apportion it, it's normally quite a chunky amount. If you think about how much might be spent on rent for your home, including all the home bills, like with heating, electricity, and gas going up, it's a good time to take stock of how much you're spending there, plus how much time you might be working from home. And you can apportion out those costs based on the number of rooms and the percentage of time that you spend working. Taxed, as a platform, which we may show you later, can handle that for you. But it's good to know that you can apportion out costs for home bills, rent, mortgage interest if you bought a home. So keep that in mind. We had one user actually who was on, I think on Monday, yesterday, or on Sunday, who was saying that they've never been able to claim working from home costs until they saw that they could claim it. And they were paying a large amount of rent each month, and using that to cut down on their total income was a great way for them to save on costs. I actually also had one, a personal, I guess, example. Because we've been all sort of working from home for the last 2 years, my lower back has been an absolute pain for the last week. So I went and saw a chiropractor today. I was doing some research on it because I was thinking, can I expense this? But actually, because you can't apportion out medical expenses apparently. So I can't claim expenses for my lower back pain, which I think has been caused from work, but I'll have to have a go at HMRC for that one. But let's take a couple of examples. Home bills, which we were just talking about. So rent, electricity, heating, water bills, and so on. Can we expense it? And the answer is yes, if you use your home as an office. So if you do some work at home, even if it's just a bit of admin, it's worth claiming back on the costs while at home. And as you can see on the right-hand side, the costs of energy bills are increasing. So it's definitely worth keeping track of what you're spending there, either on a spreadsheet on Xero, or you can use Taxed as well. Keep track of it, and it will help you reduce that tax bill. Car running costs, things like fuel, MOT costs, tax, insurance can also be apportioned. So if you're paying a lot for these type of costs, it might be worth keeping track of it. There's also a second option here. Similarly, when working from home, you can take a flat rate based on the hours you work. Taxed will pick the most efficient route for you. Similarly, with car costs, you can claim a mileage allowance. For example, if you drive for 100 miles or 1,000 miles, you can get 45p per mile up to 10,000 miles. And we'll kind of handle those calculations. But it's good to be able to know that you can do either. And picking the most efficient route sometimes just helps to lower that tax bill. Sometimes mileage can be a bit easier because you don't have to worry about any receipts or record keeping. All you need is a travel log of where you've traveled. In case you are investigated, you can say, right, here's the miles that I've done. Here's my sort of travel log to prove it. This is how I've got to my total mileage figure. And at 45p per mile, it's quite good. So for example, if you drive for 10,000 miles, it's a £4,500 tax deduction. Final one, a flight to Dubai. So this is quite an interesting one. If you are flying out to Dubai in summer, in winter, in the next couple of months, or maybe you've already flown out to Dubai or to any other location, can you expense it? And I guess we have to ask ourselves, was that trip for work? And if you are meeting clients, if you had a meeting out in Dubai, even if you may have done some personal, incidental holidaying while out there, you can still expense that trip. So although it may not have been wholly and exclusively for work, it was kind of booked for work, incidental personal use is usually fine with HMRC. And that's the same with also mileage expenses, or when you're sort of traveling. If you drive for work, but then you incidentally stop off at a Greg's or stop off and get some food, Nando's, whatever that may be, that part still counts as work as it's incidental. Any questions on expenses, feel free to throw them in the chat. And then we'll move on to sole trader versus setting up a limited company. Eamon, over to you.
Maybe just on a mileage piece, because keeping this travel log, like, do you need to write it in the spreadsheet that you like kind of track your miles, or how would you do that in a sort of like nitty-gritty perspective?
Yeah, I would actually just recommend, like, estimates are fine. So usually what would happen is, right, if you know from my experience what clients have done, if they are checked, they know, okay, well, I go to X location a couple times a month, I go here, and then they would almost just put it together once the investigation is made. But of course, in practice, it's good to keep it tracked with your expenses each month. But normally all people do is in the spreadsheet, they would just break it down literally month by month, and it would just have sort of miles covered. So it could just be 100 miles, and it could just say going to sort of client office, going to meeting, and that be that. To be honest, it's quite flexible as long as you show that there's some form of sort of tracking.
Amazing. Is that something that is busy like within tax, so I could just at the end of a month say, okay, this is how many miles I traveled?
Yeah, exactly. So at the moment, it's the year total figure. So we would ask sort of how many miles. But moving forward, as we sort of make product developments, that's exactly what we want to do. Is just be able to ping you a little question, how many miles you do this month, and yeah, we can store it on the go.
And how is it? Because I mean, some people use cars. I'm living in a city, so I mainly just go by bike or by bus. When I meet my clients. So yeah, how would I expense that?
Yeah, great point. So bike as well, you have a flat rate allowance, but it's slightly less. So it's 25p a mile as opposed to the 45p. And equally, if you are traveling via public transport, those tickets can be claimed and kept as well. But those ones, similarly to your normal expenses, you'd want to have them on sort of a bank statement that, you know, you've spent £30 on the train ticket.
Amazing, thank you.
No worries. Cool. So yeah, I guess this part then it's becoming a bit of a hot topic at the moment, as a, you know, with the question of when should I actually incorporate and should I be running as a limited company as opposed to a sole trader. So in some next slides, I've got some actual examples showing the figures you would pay in tax based on certain revenues on each method. But just before I show the examples, I guess the considerations for the two is, of course, as a sole trader, you are essentially taxed at the income tax rates, right? Just like if someone was employed, when you go through self-assessment, you use the normal 20, 40, 45% bands here and your income. So once you've taken off your profit, and you have your net profit figure for your sort of self-employment, that will then be run through the rates. Whereas, of course, if you have a limited company, once you take off sort of all the expenses, your profit is taxed at the corporation rate, which is currently 19%. Now, of course, as an individual, you are, I'm sure for you guys, want to bring the money to your personal account. So you want to get all the money to your current account. So withdrawing the income, there's specific efficient routes of doing this, which I'll show you in the next example. But essentially, through a company, you would pay yourself a salary that is at the NIC and tax-free threshold. That would reduce your profits further in your business. Then once you've paid the corporation tax at 19%, the remaining profits can be paid as a dividend which again are taxed lower than standard income. Now, it depends on the income your business generates as to when this becomes best practice. Typically, in all scenarios, it is more efficient to be registered as a company. But if the earnings are lower, then some people say, actually, because of the admin burden or reporting I need to do, I'm just not going to do it. But hopefully that's where us with tax and making things easier, the technology essentially bridge that gap. But on that sort of reporting differences, we talked earlier about the self-assessment you need to do. And I guess with a company, you would still need to do your self-assessment to report your dividends. But on top of the self-assessment, you would have this extra requirements of sort of filing your company accounts and confirmation statement with Companies House. So that would be each year you would file a corporate tax return and a balance sheet. And at the same time, once a year, you would just make a confirmation statement to Companies House detailing if any of your sort of business details have changed. And usually accountants are charging upwards of nearly £1,000 for this sort of company compliance, which is why a lot of people, if they're smaller, stay as a sole trader, which is something obviously that is getting addressed by us. But I guess as well to factor in the sort of sole trader versus limited company is your overall situation, your plans moving forward. It's very important to be forward thinking in terms of your business. If you, for example, are expecting a new contract or you're going to be sending out certain invoices, it may be, smart to incorporate before issuing those. And for example, getting the income into your company and withdrawing it maybe at a different tax year. So you always need to look at when your income's coming in and how much, and are you going to be running it as a one-man band, or is there going to be a bit of a team, and are you profit making or are you loss making? All these things need to be taken into sort of consideration when looking at whether you should be a sole trader and limited company. But I think the examples, Arj, if you don't mind flicking the slide, will be quite interesting for everyone. So here I've sort of broken it down. I've got two examples. One here is a 36,000 revenue with 6,000 expenses and a 30,000 net profit. And the next one is higher. But if we look at this example for now, I think the interesting highlight before I get into it in detail is the overall tax you pay as a sole trader is around 5,500. And as a business, it's 4,500. So there's £1,000 difference. So you're £1,000 better off as a business. Now, why is that sort of the case? I guess the key factor to sort of note here is national insurance in the UK is not applicable to dividends, right? So when you're a sole trader, you are paying yourself as a salary. So you need to pay class 2 and class 4 national insurance. Whereas when you're a company and you pay yourself the dividends, you only have to pay the tax, and the dividend tax is a lot less. So if I sort of walk you through quickly high level on these numbers to sort of so it makes sense. What we've essentially done here, the top is the sole trader. So as we've mentioned, 30,000 on the self-assessment, you pay your tax, national insurance, and there's your bill, 5,500. Also, if you have student loan, that would give you sort of a £250 bill there. Now, as a limited company, you would pay yourself sort of the most efficient salary. Now, it's the average is 11,900, and I didn't want to overcomplicate it here, but it was actually thanks to our friend Rishi Sunak, who decided to make a national insurance change in July, mid-tax year. So here essentially the first few months, and again, some of you actually may be operating a company right now. So the most efficient would be to pay an average of a 9,880 salary for April, May, and June. That keeps you under so you would pay no national insurance and no tax. You can then up that to an average of 12,570 from July. as the national insurance thresholds are increasing. So you would then pay no national insurance or tax. So essentially across a year, you can pay yourself 11,900 salary with no national insurance and no tax. So in this example, that leaves around 14,500 in the business that you now want to withdraw to your sort of personal account. Now that entire 14,500 you can take as a dividend. You then get extra dividend allowance. And then, as you can see, the dividend tax equates to £1,049. So that's how the saving comes in. It's also interesting to know, if any of you do have a student loan, what happens is, because you are paying yourself the 14,500 as a dividend and the almost 12 grand as a salary, you're actually under the threshold in terms of income, because what you need to look at is the business and you as an individual are completely separate. So you as an individual, when you run as a company, are getting two forms of income. You're getting your salary from the business and you're getting your dividends out of profit. So those two are added together to give your overall take-in, rather than looking at your business revenue as a whole, which is completely separate in the limited company. So you often find as well, when you are a student, paying a student loan, like myself, you are reporting less income on your personal basis, which means you have less income for student loan deductions. So in this example, there would be no student loan. So it's quite interesting to see that even at a lower end, there is quite a substantial difference. Now, £1,000 difference, people often say, well, because of the accountant would charge, £600, £700, £800, I'm not going to bother. I'm just going to do it in the personal way. And that's really where I've mentioned before, with technology, we can get all this compliance at low cost. There's an extra £1,000 in your pocket there, right? To either, reinvest in yourself, in your business. And actually, that's a good point. If you were wanting to make investments for your company, then you would only have to pay the corporation tax, right? You do not have to take out the remaining as dividends. Just for the purpose of this example, I was showing the comparison between the two. But if you wanted to pay yourself the smaller salary, so you pay no tax, no national insurance, so then you have the sort of £18,000 here remaining, you could pay the corporation tax and you could have 14,500 in your business account, and you could pay yourself just the 2,000 tax-free dividend and leave 12,000 in your business account. There's no requirement that you have to empty it. And you may want to invest that for your business next year. Equally, it's important to know, if you know, for example, oh, my revenue is going to drop next year, or I'm going to do something different, I'm going to go traveling for 6 months, you can keep that money in the account and pay yourself a salary next year, right? In the new tax year, where you get the new rates and thresholds. So I guess the corporation gives you that flexibility on how to sort of make payments to yourself. And then the second example, Arj, if you don't mind flicking it, just shows it at a larger scale. So as you can see here, it makes a real difference once you go over the £50,000 mark. And the reason being is that the income tax rate over 50,000 jumps to 40%, as some of you may be aware. So that's where the difference, where the corporation rate currently stays static at 19%, the biggest sort of difference comes in. So you can see here on this example that as a sole trader, so if you were running as sort of your own, through self-assessment, and you made a 63,000 net profit, you would pay 16.7k in taxes. And if you had a student loan, a further 3,200, compared to if you operated through the company efficiently, you would pay 13.9. So about £2,500–3,000 difference here. And that just starts to get more and more and more as you sort of go up in terms of revenue and net profit. So I guess that shows you in actual numbers in terms of how it's going to affect money in your pocket, and clearly it is usually much more efficient to be as a company. But I guess before we carry on, I've just spat out so many numbers to everyone there. Was there any questions from anyone, or anyone, if anything, anyone need any clarifications?
Hannah is actually just asking, like, does tax currently only work for the UK, or is it like a global thing?
Yeah, so at the moment it's UK businesses. We can account for income from abroad if you've invoiced sort of clients abroad, or you have income coming from overseas. But yeah, at the moment it's UK compliance, and we have obviously ambition in the future to go overseas. But yeah, right now it's UK.
Awesome. And then, like, one question I have in terms of when you're starting to pay yourself a salary, you basically need to run like payroll and things, right?
Yeah.
So how do these things kind of like come in? How would I have my company do payroll for me, basically?
Yeah, no, great question actually. So yeah, if you have a company with 9 or less employees, you can run a free payroll directly from HMRC. So you would have your business gateway account, and you could sort of log in and set up the payroll through there, and you could just put, you know, one individual, it could be yourself, and then you could put the amount. Again, it's something we are going to all build into the ecosystem as time goes, but yeah, for people right now, it can be done for free from HMRC if you have 9 or less employees. Yeah.
Amazing. Thank you.
No worries. Cool. So I think that sort of covered the comparison. Like I said, there's also the point of understanding your liability. A key point people often brush over is obviously the limited company. It's the reason it's called a limited company, right? It's because you have limited liability as the owner. So if you operate under a company, if anything was to go wrong, I know in the studies they love to use the classic example, like, you know, if you're a self-employed dentist or doctor and you kill someone, you're going to be in a lot of trouble, more trouble in your own name as opposed to a business, because you as an individual are completely separate to your company. So if any issues occur, if you were to get sued, or someone says you didn't complete your services as you said, I'm not paying you, you know, any sort of disputes, it's much safer as a company, because you as an individual are not the one being sued. It is whatever your company name is called. So it's not on your record as an individual. And one point I would make as an advice is, if people are operating as a sole trader in their own name, it is always worth to have some insurance for those sort of things. You can get them in various places, sort of a sole trader insurance to give you some protection if you operate as your own name. Cool. And I think sort of 10-15 minutes to go. Arj was going to give a quick demo on our platform if there's no further questions at this point.
Sounds good. We've got some time saved for questions at the end as well. So we'll just kind of take you through tax at the moment, and we've also got a code embodied. If you do need to file, it's the new tax year. Feel free to reach out to myself and Eamon as well. We can support you, but we'll show you tax, but at the same time, have a think about any questions that you may have, and we'll do a short Q&A for the last 10 minutes after this. So taxed, I guess we built this really to feel like you're having a conversation with an accountant, and it's partly because we know software can sometimes feel like you're just sort of filling out a spreadsheet. It feels archaic. It doesn't have that human element to it. So we wanted tax to really feel like a conversation. You answer questions, and we decide what questions to show you. So based on the questions, based on the answers that you provide to us. And we've got a couple of categories here, things like the introduction, self-employment, credits, and deductions. And through each one, what we're doing is we're using the information and all the sort of data behind to provide you with the most efficient route and the questions that relate to you. As an example, because I'm self-employed, I can see the self-employment category on the left-hand side. And within this, I can then see questions that relate to my self-employment. But for me, one of the most important bits is the type of industry that I'm in. So if I'm a freelancer, a content creator, creative, and so on, I can see exactly what type of expenses I might need to know about in this industry, which makes it quite specific to me as a person, so that if I'm in construction, I can expense my helmet, my tools, my machinery. But if I'm a freelancer, I may not care so much about helmets and boots and things like that. And then we ask questions around income, earnings, and so on. And this is where we then sort of go into that tax efficiency that we were talking about earlier. Expenses, using a phone for work, you don't have to worry about the calculations. Tax will handle that all for you. As long as you know your annual costs and the percentage of time, even as an estimate, that helps us to then decide how much we can use as a deduction on your tax return. You can see here, we've got the working from home expenses as well. And you can see how that can then add up and create your tax return. Once self-employment's done, we then also ask you about credits and deductions. And here are things that we've not talked about today, but something I find quite interesting. So if you do have any questions on it, let us know, and we can also support you after this call. Things like putting money into a pension can extend your kind of basic rate band, so the amount that you pay tax on the 20% rate, plus you get additional relief that goes into your pension. So it's quite a worthwhile investment in the long term, and something that we would also sort of recommend. Things like pension and sort of giving to charity, extending that sort of basic rate band can help, especially if you're earning around 48 to 50,000 pounds. That's when you get that's when you move into the different higher rate bands of brackets. There's also things like kind of venture capital schemes. So if you're investing in startups, you can get relief. Some of that relief is up to 50%. So as an example, if you invest £1,000, HMRC will give you £500 back for that investment. So that's some of the credits and deductions that we'll ask you about. And then it goes into your personal info, just so that we can get some information around what type, what address, what sort of phone number and things like that HMRC require. Then what is quite cool is then you get your SA 302, which you can use for your mortgages. But also this is where you can see how we've calculated your tax amount, which is quite interesting. And that's pretty much it. So then once you're ready to submit, you can then send that off to HMRC. Cool. So yeah, that's taxed in a couple minutes. Hopefully that sort of gives a bit of a flavor to what we're building. But our overall aim is really to build something that resonates and that aligns with what you're doing and aligns with your businesses as well. So if you do have any thoughts or feedback, please let us know. We'd be more than happy to help. But I guess that gives us the final 10 minutes for questions, if we have any, and we'd be happy to answer anything. I think I've stopped sharing my screen. Hopefully that's
Yeah.
Yeah, folks, that was amazing. Thank you so much for bringing the expertise. So yeah, if there's any questions, just write them in the chat and we'll get to them.
Yeah, doesn't have to just be as well on what we talked about. If there's any random questions or comments or thoughts on tax and moving forward, and look, the people who said they were stressed about it earlier, or the negative comments, be quite good to know why as well, and if there's something we can address and help with. So yeah.
Maybe in the meantime, you spoke earlier about like apportioning costs. How do I need to take care of that? Do I need to keep the bills and then basically just say, okay, like roughly 75%, or is there more specific ways that this needs to be accounted for?
So that can normally be quite rough.
Mm.
You only need to keep I guess sort of two ways. If you file with taxed, we will do the apportioning on our side in the calculations. So you just need the total amount that you spend on your bills, car costs, and so on. If you're filing yourself, you will need to work out how many rooms are there in your house if it's sort of working from home costs, and then apportion it based on the rooms that are in the house and then how much time you spend working in that specific room. But always start with the total amount that you've spent, and then you apportion it down into the specific amount for work. And it can be sort of estimates. HMRC know that it's not going to be the most accurate sort of figure in the world.
Okay. And then when you were showing the software just at the end, can I basically submit things sort of continuously, or is it only sort of like once a year that I'm building that out?
Yeah, so you can I guess use tax to on the go to update sort of figures and stuff, and the tax calc as well will provide you with a tax estimate. But as well, you can submit amended tax returns. As an example, you can submit a tax return now, but then if in a few months' time you realize you forgot some expenses, you can submit that again at no additional cost. You can just kind of keep submitting. I think the deadline for amended returns is exactly 1 year. So for the tax filing sort of deadline at the moment is 31 Jan 2023. So the amending for that is 31 Jan 2024, if that makes sense.
Absolutely, yeah. And then you were speaking about pension as well. And so, like, if I'm running a limited company, then does the company pay part of my pension? Or would my pension come out of sort of the salary allowance that Eamon was talking about?
Yeah, so it'd actually be something which is entirely up to you. So what you can do is, as sort of you have that total separation as a limited company, you can set up your own sort of occupational pension scheme. So what that means is you would register with a provider as your business, and you would say you are the employee, and it would be taken off sort of your salary when you pay yourself. So you'd get the relief through the wage you're paying yourself on payroll. What I would say though is, if you are doing that sort of corporate route and you're paying yourself that smallest sort of salary we discussed, in that instance, you wouldn't actually get any extra relief, if that makes sense. You would just get the standard 20% the government gross up when you sort of input it into your pension. So if you're to make £80 a month contributions, you would get £100 in your pension each month. So that would be given by the provider in sort of your actual pension pot. If you wanted to get extra relief, so that's a payment back to you, that's where you need to be earning over that sort of 50 grand allowance, because if you're a 40% taxpayer, you would get the extra 20 back. So yeah, pensions is great for high earners, and if you are paying yourself, say, the minimum salary, it's something to consider from a tax efficient perspective. But of course, if you are looking to save for the long term, then it still makes sense.
So would you say basically from tax efficiency, if I understand you correctly, it's only really making sense to look at tax like once you're making more than 50 grand?
For pension relief, yeah.
Pension relief, yeah.
Pension relief and charity relief, yeah.
Okay, cool. And then I mean the other piece is around sort of like property. I think Arjun, when we were speaking the last time, talking about if we as business owners think about like buying property potentially, like how to best structure it as either part of the business or as a personal investment. What's your take on that?
Yeah, again, for me, it's another big topic, which could be talked about for hours. I think overall it always comes down to the individual circumstance. So I'll give you some examples, right? If you are a higher rate taxpayer, so you're paying 40% tax on your self-employment or your job, then you're going to have to add your rental income to that, and you're going to be taxed at 40%. So if we say you have £1,000 a month rental income, and you no longer as a personal individual can deduct the full interest. So let's say your expenses are, we're including interest, normally around 500-600. You have to pay tax on pretty much the income in. So you often find that you're operating at a marginal profit, and in most cases a loss in your personal name. So in those scenarios, pretty straightforward to say incorporate, and the income is not added to your personal salary because it's separate in the business, and you'll get the full deductions of mortgage interest as opposed to in your personal name. So your profit is lower, and then you're only taxed at the corporation rate of 19%. But that's in that specific case. You've got to think so many examples. I think especially when you buy property, you need to know your exit strategy up front. So you've got to know, is this property I'm buying a rental property for 10 years plus? Am I going to sell this because I want to make some renovations? You need to know how you're exiting that deal, because if you're going to sell the property in the short term, business may not make sense because you may have to pay corporation tax on the profit, and then you have to take the money from the company to your personal name and pay further personal taxes through dividends. And that can often end up being higher than if you were to pay personal CGT at flat rate of 18 or 28%. So it's really hard to give like a definitive answer. Each circumstance is completely different. One thing, I think the main factor is as well, like, it's just your other earnings as an individual. That's so important. And your plan for the next 5 years. I think those are the two key factors when making a decision.
Amazing. Gents, we're coming to the end of the hour. Thank you so much for bringing your hardcore expertise. It's been really, really interesting for me to actually see some of these number examples, where sole trading versus company makes sense. And also thank you so much for highlighting all the things that can be expensible. I think also the piece with incidental personal usage. I think that's a really beautiful thing that you highlighted here, which is making, I think, tax efficiency, especially for people sort of in the kind of coaching lifestyle type business, where it's life and business all no longer really boom boom, but it's more kind of mingling with each other. So that was super, super helpful. And if people want to get in touch with you, we put all the links to your profiles and text into the description. Is there anything else that you'd like to share? How people can benefit from what you're doing right now?
I think at the moment, just sort of get in touch with us if you have any questions. We're more than happy to chat about taxes. We're quite sad in that way that we love to chat about tax. So just get in touch, and we'd love to discuss.
Yeah, and I'll just say as well, just don't delay things. I know it's really a common theme amongst people to sort of push back taxes and not have a look at their finances and the business and so on. But I would say it's always best to just start right away, because you may even find a situation where actually you could go back to last year and make a change and make an amendment and maybe get some money back, or I can start expensing this moving forward. So then you can straight away know next week, 2 weeks, 3 weeks time, I know what I can spend and what's taxable. So take a look at it right away. And as I've said, just reach out to us if you have any questions. We're happy to help. And
so would you basically recommend just right now doing the tax return for the tax year that ended just a few days ago? Just really getting in it, getting on it, having it sorted, boom.
Exactly, because what happens as well when you file a tax return, if you have to pay any tax, you don't have to pay it until the end of January. Just because you filed it doesn't mean you actually have to pay it. So I definitely recommend it. Probably be worth doing it now. It's great for two things, right? You know where you probably missed out on some efficiency last year, and you can then make up for it this current year that's just started, as we're in the first month of the new tax year. And also just from cash flow perspective, it gives you a bit of a heads up on what you need to expect to pay by the end of January, so you can almost prepare for it as well.
Amazing. Gentlemen, it's been so good having you.
Thank you so much for having us.
Conversation. Lots of love. See you all
Awesome.
soon.
Thanks,
Bye-bye.
everyone.
Cheers,
Thanks, Tobias. See you later.
Bye-bye.